This is the hollow center, center of nothing, edge of everything, man.
There are two kinds of money in Australia: the money politicians tell you they're spending, and the money they quietly wish they could get their hands on. The second category is where things start to get interesting, because sitting quietly behind the scenes of the Australian economy is a financial giant so large that most people barely comprehend it, a system so vast it has grown larger than the entire national economy, a system that now controls trillions of dollars in capital, a system that politicians increasingly talk about not just as retirement savings, but as a tool for shaping the country's future. That system is superannuation, and if you listen closely to the way Canberra talks about it today, you start to hear something subtle but important. The language is changing, not your retirement savings, not private investment, but something much more interesting: yani nation-building capital, which is a very polite way of saying that giant pile of money looks awfully useful. The $3.7 trillion elephant in the room, Australia's superannuation system, currently holds roughly $3.7 trillion in assets. That's not a typo. $3.7 trillion. To put that into perspective, Australia's annual economic output sits somewhere around $2.7 trillion, which means the retirement system designed to help workers fund their later years has quietly grown into something even larger than the economy itself. And if projections are even remotely accurate, that number could reach $10 trillion by the 2040s. $10 trillion. At that scale, superannuation stops being just a retirement policy. It becomes something else entirely. It becomes a global investment superpower. Funds like Australian Super, Hostplus, and UniSuper already control hundreds of billions of dollars. They invest in airports, energy grids, commercial property, infrastructure networks, global equity markets. Australian retirement savings now quietly own pieces of the modern world, which raises a simple question. Once a pool of money reaches this size, who decides how it evolves? The politician's favorite phrase. Every political era has its favorite buzzwords. The 1990s had economic reform. The 2000s had productivity. The 2010s had innovation. Today, the phrase that appears in speech after speech after speech is this: nation-building investment. It sounds noble: infrastructure, housing, energy transition, transport corridors, big projects that reshape the economy. And increasingly, when politicians talk about how those projects might be funded, they mention superannuation. Because if you're a government looking at a $10 trillion investment pool, the temptation is obvious. That capital could finance roads, transmission lines, housing developments, renewable energy projects, data centers, ports, rail networks. In other words, the entire modern infrastructure economy. The tax reform that sparked the fight, which brings us to the latest battle. The proposal to increase taxes on super balances above $3 million. The official explanation is straightforward: fairness. The argument goes something like this: superannuation receives generous tax concessions. Those concessions were designed to encourage retirement savings, but extremely large balances can accumulate significant tax advantages. Therefore, the system should be adjusted. On the surface, the logic seems simple, but critics quickly zeroed in on something else: not just the tax, but how it's calculated. The unrealized gains problem. In most areas of taxation, you pay tax when you actually receive income or realize a gain. Sell a property, sell a share, take a dividend. Income exists, tax applies. But one controversial aspect of the proposed reform is that it may incorporate changes in asset values even if those assets haven't been sold. That means if a self-managed super fund holds farmland or commercial property and the value rises, tax could theoretically apply even if no cash has been generated. Supporters say this approach reflects how large investment portfolios are already valued. Critics argue it introduces complexity and liquidity risks. But the bigger point is philosophical. It quietly changes how superannuation earnings are measured, and once tax rules start shifting inside a system worth trillions of dollars, people tend to pay attention. The inflation time bomb. Then there's the threshold itself. $3 million. The number repeated in every political interview. The line that supposedly separates ordinary savers from ultra-wealthy retirees. But here's the catch. The threshold is not indexed to inflation, which means over time, as asset values rise, more people drift across that line. Not tomorrow, not next year, but over decades. And when you're talking about a retirement system designed to last 40 years or more, decades matter. The quiet structural shift but focusing purely on the tax debate risks missing the bigger story. Because the real transformation of the super system isn't happening through one policy change, it's happening through scale. When super began, it was simply a way to supplement the age pension. Today, it has become one of the largest institutional investment sectors in the world. It influences property markets, infrastructure development, energy investment, global capital flows, and as the system grows larger, governments inevitably start to see it not just as retirement savings, but as economic leverage. The infrastructure temptation. Consider the types of projects governments increasingly want funded: housing developments, electricity grids, renewable energy zones, high-speed transport corridors. These are multi-billion-dollar projects with long timelines. Exactly the kind of investment profile that super funds like. Long-term, stable returns, predictable cash flows, which means the alignment between government ambitions and pension capital is obvious. Super funds need investments, governments need capital. The danger, critics say, is when the line between encouragement and expectation begins to blur. Because retirement savings ultimately belong to workers, not governments. The political power of super. There's another dimension to this debate. Superannuation doesn't just involve money, it involves voters. More than 17 million Australians have super accounts, which means almost the entire workforce has a stake in the system. And when a financial system touches that many people, it becomes politically explosive. Change the rules, and millions of voters suddenly start paying attention to something they normally ignore. That's why every super reform comes wrapped in careful messaging: fairness, sustainability, closing loopholes. But underneath the slogans lies a much bigger structural shift. Australia is slowly building one of the largest pools of pension capital on Earth, and the influence that capital will exert over the economy is only beginning to emerge. The $10 trillion future. If the current trajectory continues, Australia's super system could reach $10 trillion within 20 years. That level of capital will inevitably shape the country. Infrastructure ownership, energy investment, housing development, technology funding. At that scale, super funds will rank among the most powerful financial institutions in the world, not just in Australia, globally, which means the debate over super reform isn't really about one tax policy. It's about something much larger. Who ultimately controls the evolution of a financial system of this magnitude? The workers whose wages built it, the funds that invest it, or the governments that regulate it? The hollow centre. Question superannuation began as a retirement policy, but it has quietly evolved into something far more powerful: a financial ecosystem, a political battleground, a capital reservoir large enough to shape the national economy. And once a system reaches that scale, the battle over its future becomes inevitable. Because $10 trillion doesn't just sit quietly in the background. It attracts attention from investors, from governments, and from anyone who understands what that level of financial power really means.
This is the hollow center, center of nothing, edge of everything, man.